Whether you've been investing for years or you're wondering how or when to get started in investing, this video is going to be packed full of information that's going to help you build that net worth fast. Recently, I asked my followers on this channel, what's something you wish someone told you about money when you were younger? You guys delivered with so much insight, and so I thought I'd dive deeper into some of your thoughts and also give you a couple things I wish someone would have told me when I was younger as well. I'm Nolan Govea, my students call me Professor G, and I made this channel to make investing simplified. Now, like I said before, I had a bunch of you answer what you wish someone would have taught you about money a lot earlier in life. But for those of you that are new or watching this video, I'd love to hear your idea. So go ahead and throw that down in the comment section so that people have not only this video, but they also have a bunch of your guys' comments down below. Now, this first one is huge, and it's one that I hope that a lot of you are already doing. And if you're not, it's something that I hope that you do as soon as possible. And I'll show you the reason why. Many of you said the same thing, and it basically surrounds the idea of starting early or as soon as possible. Let me lay out two scenarios and you tell me which you think is going to have more money by the time they hit retirement age. Person A invests $1,000 per year from age 22 to age 30 and then never touches their money again or invests any more money. Person B invests $1,000 a year also, but they invest from age 30 to 60. So they're investing the same exact amount every single year, but they invest for 30 years total. Both people earn 10% each year on their money, which is basically what the S&P 500 has averaged for so many years. So person A invests for just those 9 years, then never invests another dollar. Person B invests for the next 30 years. Who wins? As you can see here, overwhelmingly, it's actually person A. By age 60, person B will have $181,943 and person A will have $236,953. Also, notice down at the bottom, person B invested more than 3 times as much total money as person A too. No matter what age you are, investing today and getting started now is going to be so much better than investing next year or in the next 5 years. So get started as soon as possible. If you know anyone in their 20s or even younger, send them this video so that they can get started as soon as they can. Girl Dad Investor says, make money for you. It's a tool. And with that, I think he also means make money work for you, and I couldn't agree more. Doing this right, there comes a point where your money actually works way harder for you than you even can yourself. For example, let's say you make $75,000 a year at your current job. After working long, hard hours and doing everything right and pulling out all the stops, your boss decides to give you a 10% raise, which is huge. That's way bigger than the average 2 to 4% raise. A 10% raise on that salary would be an extra $7,500 per year, putting your total at $82,500. So that's you working super hard at your job trying to make more money. But let's say on the other hand, you started putting your money to work. You've been investing for a couple years and you've amassed about $50,000 in investing. In the last year, the S&P 500 has returned about 27%. 27% of $50,000 is $13,500. You didn't have to work any longer of hours or sacrifice time with family, and you just made almost double what that raise was that you got at work. And if you had been investing for some time and you had a balance of like $250,000, that 27% last year would have given you an extra $67,500, which is like another full-time salary, again for doing 0 extra hours of work and just letting your money work for you. Nate says, pay yourself first, as in set aside some money to invest before you spend it all on stupid stuff, even if it's a small amount. This one is huge, and I'm sure you've heard this many times before, but maybe you didn't understand what that means by pay yourself first. If you think about it, as soon as your paycheck comes in, you have things that you already have to pay for, like rent and utilities and car payments and things like that. That's already taken off the top. You should train your brain to make investing, or at least saving, a portion of that. Do you know that every time that you get paid, no matter what, $200 is going towards investing? So it's almost like a bill, but it's a bill that you're paying yourself because long term, that thing is going to grow crazy. And then Nate also said, consistency. Little amounts over a long time add up. $1 a day, $10 a week. You got to start somewhere. Small amounts plus consistency beats I'm waiting until I start making more money to start investing. And that couldn't be more true. But we tell ourselves that all the time. I don't have any money right now to be able to spare for that. For me, when I'm faced with that type of dilemma, I don't say I don't have any money. I say, okay, how can I have more money? And usually it comes with cutting out an unnecessary expense or finding a way to make some more money doing something. My little addition to what Nate had to say on this, which was great by the way, is that I hope that you're doing ample research. Understand fully what you're investing in. This sounds kind of like duh, but most people don't do this, and then when the market downturn happens or their stock drops just a bit, they get freaked out and sell. And that's literally the only way you can actually lose money is by selling or panic selling. When the market dropped a bunch about a year or two ago, my DMs were full and my emails were full of people asking what I'm gonna do with my money and if I'm scared that I'm losing all this money. Yes, the market was down and it was a bit gut-wrenching to watch your $50,000 turn into $35,000. But since I had done so much research beforehand and understood what I was investing in, I totally understood that the economy was down just in a normal cycle. And this had happened many, many times before with these ETFs that I talk about. And every single time, once they get through that cycle and market correction, it comes right back up, which is what we're experiencing now. So had I sold then, I would have lost all this gain that we're getting right now. I doubled down, I just bought more, and I knew for a fact that it was gonna come up because history's on our side. Little disclaimer here, not all ETFs are just gonna come right back up, and not all stocks are just gonna come right back up. So you do need to do your research, and it's why I pick ETFs and stocks that have a solid history, so that we can kind of look at what the data shows and what they've done in certain recessions or drops in the market. Past performance doesn't equal future performance, so you can't just look at something and say that because it did something in the past, it's going to do that in the future, but we can look at patterns and we can make good educational forecasts based off the data that we're presented. Camille says that money comes and it goes. It's just a constant cycle we fixate on when in reality it's not real. We're dealing with monopoly money. Think about it. You pass go and collect the same cash flow, and then you go around the block and spend money on unnecessary and necessary things, but when you pass go again, you collect. Out of all the comments that I received on this post, I think this one takes the cake. Now, I might be a bit biased, since this is my beautiful girlfriend, but also this is so incredibly wise and important for us all to understand. While money is essential, it isn't everything. It's so easy to lose sight of the real priorities in life, and money does a great job of stealing that spotlight. This is why I built this into my channel, to be honest. My style of investing is where somebody could spend about 5 minutes per month putting money in the correct places and then just setting it and forgetting it and not having to worry about it on their brain and checking it every single day. My goal is for your net worth to increase steadily so that you can be stress-free and you can just go out and have fun with your friends and family and enjoy this life. Be diligent with your money, spend less than you make, invest a portion, and be generous with some of that money. And I promise, everything's gonna work itself out. The last one here is about the different types of investing vehicles you can choose. A lot of you agreed that the Roth IRA is smart, and I would 100% agree, but I also want to highlight something else. First, for those of you who may hear us talk about Roth IRAs and that they're amazing, but we don't ever really go into exactly why they're the most amazing vehicle that's out there, here's a very quick, simple explanation. When you put money into a traditional IRA or a 401k, it's a retirement account with the idea that you're putting money away now, so you're not actually bringing that money in as income, so you're not going to be taxed on that money right now. Later on though, when you do pull that money out of those accounts, it will be looked at as income and you will be taxed at that point. With the Roth IRA, it's the opposite. You're going to put money in that's already been taxed. So in your employee income, you're already been taxed. So when you put the money into the Roth IRA, it's not like you're taxed again, it's just that you've already been taxed on that money. The crazy thing about this account is that all the money that it grows to and all the dividends that you get within that Roth IRA from then on, whenever you pull that money out in retirement age after 59 and a half, is totally tax-free. It's not even looked at as income. This is huge because, like the example from before where your money can work harder for you than you even can, to be putting that then in a vehicle that's also going to be totally tax-free, that's crazy. So yes, the Roth IRA is amazing, so is the regular 401k or even regular IRA. Any of these types of retirement vehicles, So important, you're gonna be very happy that you did this later on in retirement age. But I would definitely add this. It's also very important for you to be thinking about your midterm future as well, not just long-term. Retirement accounts get you very safe later on in life after age 60, but what if you want to have a little bit of passive income or slow down a little bit in age 50 or 55? If you can't touch that money till after 59 and a half, that's going to be tough. For myself, and maybe for those of you that are under 45, I would highly recommend that maybe you put about 70 to 80% of your money into retirement accounts, but then put 20 or 30% into a regular taxable brokerage account. You don't know what the future is going to hold, and you do want to take advantage of the tax advantages of either type of retirement account. But I know for me personally, I wish that I would have started investing in my regular brokerage account a little bit earlier. When I was about 20, 21 or so, I started investing lightly. I didn't really have a lot of money, but I started investing a little bit, and all I was thinking about was 40 years down the road at age 60 for retirement, because I would look at those compound interest calculators and it would be super cool to see how much it grew. And that is awesome. But now I'm 35 and I'm seeing that there's a very real possibility that I can be retired a lot earlier than age 60. And so I would like to be able to use the money that I have. So for me, I'm putting a little bit more into things like my taxable brokerage account and even high yield savings account, especially with how high those yields are right now. And so I'm looking more at that short-term / mid-term type range. And so I just highly recommend that you look at your financial future and just look at where you're at and try to plan out something midterm and long-term. But without a doubt, I'd 100% agree that the Roth IRA is the most important retirement account that everyone should have. And so if you don't have one yet, make one soon. In this video here, I go over the top 5 ETFs that you should buy and hold forever within your Roth IRA. And in this video, I go over my plan to make millions in the stock market this year with recession-proof investing.